Welcome, everyone, to this week's episode on Dollars with Sense. My name is Ela Lange, and I'm here with my co-host, Terence Woude. Today's topic is estate dollar tax choices, and that's part 2 of our 2-part series. We'll be using the case study to provide insight as to how it all works.
As this is the second part of the series on estate tax dollar choices, we are going to be looking at our case study, Roger Brink, who is not expected to live past the next 2 years. As sad as this is, it has propelled Roger to think about what he is going to leave behind to his heirs. Everybody knows the old saying that you can't take it with you, but what Roger has realized is that his money will be left behind, and he wants to make sure he's smart about it.
Through Roger's situation, we are going to show you in this episode how he and anybody who is looking at their estate tax issues can make a really impactful choice to either give the final estate tax dollars that will be owed to the government, who will be very careful to make sure it gets used properly, right? Ha! Yeah. Or gift it to your favorite charity who will be able to put it to the most meaningful use to Roger. This kind of smart financial planning can have a sizable impact on those organizations Roger cares about the most.
Yes, after this session, you will know how different assets are treated by the taxman upon death, how one could organize their finances to increase legacy and reduce estate taxes, how even a modest amount of money can create a private foundation, and how well you have yourself positioned regarding your finances both now and for your legacy. When we come back, we'll dive right into it. Grab your cup of tea, a paper, and your pen, and be ready to have your eyes opened by Ella and I, your 2 financial gurus, here on Dollars with Sense.
Welcome back to today's topic of Part 2, Estate Tax Dollar Choices. I'm Ella, here with my co-host Terence, and we're your 2 financial gurus, enlightening you this week on how to set up an estate that will either have the tax bill go to the government or to your favorite charity.
You have heard it many times before. There are 2 certainties in life, death and taxes. Well, we don't call it an old adage for nothing, because on both of these subjects, I guarantee that each and every one of you will experience it. We all know we can't take it with us, but as we said before, what we really should be focusing on is that it will stay behind.
First of all, let's review our case study, Roger Brink. Roger is a retired 65-year-old man who has recently been diagnosed with terminal cancer and has been given 18 to 24 months to live. He's been a widower for 6 years now and has 2 married adult children and a granddaughter. You'll also see on your screen the case study details, and you can follow along with us in that way. So if you're not looking at your screen, you can go on over to our Facebook page, Dollars with Sense. Send us an email, if not, to 2financialgurus@gmail.com, and we're very happy to email that to you.
So let's look at the case study chart that shows all of Roger's assets. In our last episode, we discussed in length where and how Roger has invested his assets. Now we're going to itemize how much he has in each of his assets and how much will be added to his total income for his final tax return. His total RSP market value is $130,000, and that taxable amount on that is $130,000 because it is a registered account. His residence is worth $600,000, but because it is his primary residence, he is exempt from capital gains tax, so his taxable amount is $0. Securities equals $100,000. The ACB, or the actual cost basis, is $10,000, as this is how much he spent over the years when buying new stock. The rest was gifted to him from his father, and it has grown and gained from stock market returns. Taxable amount equals to $90,000, but because it is capital gains, the government says, good for you, you get 50% of that gain tax-free. The rest, $45,000, is added to his total gross income for the year.
Real estate. So we've got $220,000 for the condo in Kelowna. The original cost, including renovation upgrades, was $112,000. So that leaves a capital gain of $108,000. Again, because it's capital gains, only $54,000 will be added to the gross annual income. Now, as GIC has only made $2,000 worth of income, but it's been income by interest. On a brief aside, there are only 3 ways that money makes money. 1, capital gains. 2, through dividends. Or 3, by interest. Interest is the only one that is not tax preferred. It's not a tax preferred investment and therefore is taxed at 100%. This is another reason why the GICs that so many have their savings in is a very inefficient place to hold your assets. So, $15,000 in the TFSA or tax-free savings account is exactly that. It's tax-free. So this is not added into the taxable income. It's a really good way of thinking of a TFSA is that it's tax-free for life.
And finally, all his passive retirement income totals to $65,000, and it is all taxable. To keep things simple, we are assuming that this amount is taxed at 100% and there are no deductions. All of this taxable income adds up to a final year of income for Roger that exceeds the maximum tax threshold of over $150,000. So, his marginal tax rate will be 45.8% here in the province of BC. Looking at the next slide on your screen, you will see the income numbers are all the same, but the numbers on the right are different. These numbers show a probate fee of $17,360, which is 1.4% of the total worth of the estate. The income tax bill of $135,000. The total amount of his estate that will go to his heirs is $1.02 million, with a total of almost $153,000. That is the government's share.
The other factor that's not thought about much is the process time of an estate. You can imagine the process time to settle the will and inheritance is also in the hands of the government. And the more complicated the estate, the longer the process time. Roger's loved ones can expect a 12 to 24 or more months before the probate court is finished with their processes. Financial concerns aside, the lingering element of the settlement of the estate can take an emotional toll. The closure that's needed for Roger's loved ones will not be complete until after the estate is settled and the inheritance is passed along according to the wishes of Roger's will.
Now, this episode is called Estate Tax Dollar Choices, and here is the reason why. The tax bill is due. There is no other way to avoid this bill, but the government, with the help of smart financial planning, has made the opportunity available for this tax bill to not go to the government, but instead can be given to a registered charity. When this happens, the charity gives the estate a 100% deductible receipt and greatly reduces the amount that the state owes to the government. You will be able to see this clearly in the next few minutes.
We're going to take a quick break, and when we return, we will look at the different gifting options that are available and how they are treated. In the meantime, if you have any questions or comments, we would be happy to connect with you. You can reach us either by leaving us a comment on our Facebook page, Dollars with Sense. You can email us at 2financialgurus. That's the number 2financialgurus@gmail.com, or certainly call us at 778-879-0820. Don't go away. We'll be right back. Thanks for joining us today. I'm Ela Lange with my co-host, Terence Vanderwood, and we are discussing the estate dollar tax choices that are available to every individual. This is a 2-part series as there's a lot of information around estate tax and planning. So we're looking at our case study, Roger Brink, who has a fairly typical estate compared with most Canadians.
As we mentioned in the last segment, we have calculated that Roger's estate will be looking at a $153,000 tax bill and has a possible opportunity of reducing the amount that goes into the government coffers by about 94%. Not only that, but this will direct that amount of money to the charities that Roger cares about. This is a very powerful way to maximize the philanthropy and the legacy of Roger Brink. And how it is all achieved, you ask? Well, by gifting.
Gifting can be done for many reasons, for philanthropy, as we mentioned, or to establish a legacy, and of course, to save tax. As with all details when it comes to taxes, there are parameters and maximums that govern this area of tax law. A charitable donation is eligible for federal and provincial non-refundable tax credits. The federal tax credit is 15% on the first $200 of a donation and 29% on the donations above $200. The BC provincial credit has the lowest tax rate on the first $200 of donations and the highest tax rate on donations above $200. There's an annual limit for charitable donations claims, which is 75% of net income for that year. One can certainly give more than that to a registered charity, but the tax deductions will only apply up to 75% of the net income. On the other hand, if the gift is made at death, the limit is 100% of net income in the year of death, plus 100% of the net income from the preceding year. In Roger's case, as he makes $65,000 per year, his estate is eligible for $130,000.
So there are many options when it comes to making a planned gift. You can make a bequest to a charity in your will, establish a charitable life annuity, establish a private foundation, donate publicly traded stocks or securities, bequests of registered plans or life insurance policies, or donate a life insurance policy.
The most common way to utilize planned giving is to include the instructions in your will. The disadvantage of doing it in this way is that the probate fees, as we discussed at length in the previous episode, will be part of processing the will. In BC, the probate fee rate is small, only 1.4%, but when you're dealing with hundreds of thousands of dollars, those fees can add up pretty quickly. Establishing a charity life annuity enables one to have the tax deductions today while you are alive. This also creates a regular income for the charity, which makes managing the cash flow of the non-for-profit that much easier. Establishing a private foundation can be a very rewarding way to see the impact your dollars have again while you are alive. A little later on, we'll get into greater detail around this area with the Investors Group Charitable Giving Program to establish your own private foundation with as little as $25,000.
Donating publicly traded stocks or securities, quote unquote, in kind to your favorite charity means less tax, as you are not required to report any resulting capital gains. For example, let's say you want to leave a charity $20,000 in your will. If you do so this way, your estate will receive a tax credit for the $20,000, probably in the highest tax bracket, saving the estate about $8,000 in tax. Or, another smarter way to handle this, is you leave shares of a publicly traded company, for example, TELUS shares, worth $20,000 that has an adjusted cost basis, or how much you paid for them, of $5,000. Your estate would receive a tax credit for $20,000, and the $15,000 capital gain will be exempt, saving an additional $3,000 to total $11,000 in tax savings for your estate. Using this method also leaves the registered charity exempt from the capital gains tax.
You can also change the beneficiary of a registered account, like an RRSP, for example, or a life insurance policy that you may have not needed for heirs or other purposes. And finally, you can take out a life insurance policy on yourself. Have the registered charity be the owner and beneficiary of the policy, and you as the payer of the premiums. Doing so this way gives you, the payer of the premium, the ability to deduct all your monthly payments from your annual tax bill today while you are still alive.
So let's go back to our case study, Roger, and take a look at the solution we have recommended for him. On your screen, you will have a visual reference of our recommendation. If you are not looking at your screen, get on over to our Facebook page, Dollars with Sense, or send us an email at 2financialgurus@gmail.com. That's a number 2financialgurus@gmail.com, and we will email it to you. In the meantime, here is how we recommend Roger to redirect his estate tax bill to reduce the amount that goes to the government by 94%. RRSPs are worth $130,000. If Roger changes, as we recommend, the beneficiary to be a registered charity, so that when Roger passes, the registered charity will receive $130,000 and issue a receipt for that amount to his estate. His residence worth $600,000. We recommend establishing a home equity line of credit, or a HELOC, for 65% of the market value of the home. This way, Roger is protected from big unexpected health costs. When he passes, the money that Roger has unlocked from his home will be paid off with the sale of the home.
The securities worth $100,000 should be sold in the near future and given to his heirs directly. This will save some of the probate fees and allow Roger to lessen his overall estate size, which also helps in reducing the amount of time that the rest of the estate sits in the probate process. And the apartment in Kelowna, worth $220,000, should also be sold and given to his heirs before he dies for the same probate process reasons I just mentioned.
We also recommend that the GIC, or the Guaranteed Investment Certificate, be dissolved. And some of those funds are used to maximize his allowable tax-free savings account contributions. Each individual over 18 years old is eligible to have up to $46,500 in contributions into a TFSA. Roger should take full advantage of this, as it will again be possible to give before he dies, reducing his total estate probate, and can act as another cushion for him in case there is a financial shortfall. Finally, the income of $65,000 will remain as is, because this is equal to his usual annual expenses, and presently there are no real options to sheltering this income from his taxable income.
So assuming that Roger takes our recommendations and implements them all, his estate tax bill will end up looking like this. He will still be in the highest tax bracket because his total income for the year will be over $150,000, which means his marginal rate will be 45.8%, the same if he did not take our advice, but he will have greatly reduced the size of the estate and therefore reduce his probate fees from $17,000 to $9,300. The income tax he will owe will still be around $124,000, but because he donated his RRSPs to a registered charity, he will receive a tax credit of $130,000, wiping out his tax bill to the government. The amount of inheritance to his children and grandchild will actually go up a few $1,000s, and the process time will be greatly reduced as his estate is not complicated and therefore will be processed faster. So that leaves Roger's estate to pay the reduced probate fees only to the tune of $9,300 instead of the $153,000 if he does not take our recommendations. Roger, of course, is a smart individual and clearly sees the benefits of reducing the amount he gives to the government by 94%.
Great job, Roger. This makes me very happy, as this kind of planning and detail can make a real significant change in the world, especially if more people decide to take care of the money they will leave behind. Again, all of these details are also available to view on our Facebook page, Dollars with Sense, in either video format or in a transcript. If you are having trouble finding the details or need more answers to your question, reach out to us by email at twofinancialgurus@gmail.com or by phone at 778-879-0820. We will take a quick break, and when we return, we will look more closely at what a personal foundation looks like and, of course, your action items here on Dollars with Sense. Welcome back to Dollars with Sense, where your two financial gurus, Ella and I, are enlightening you around the benefits of solid financial advice. We are wrapping up our two-part series on estate tax dollar choices, where Roger Brink, our case study, has just saved 94% from disappearing into the ether of the government and supporting his favorite registered charities.
The last item we'd like to discuss with you today is a unique program that Investors Group offer to its clients. Strategic Charitable Giving Foundation. This program allows your legacy to go to your community and is designed to help you give in your own way. It offers simplicity because it consolidates all your charitable giving into one account. It has great cost effectiveness as it receives many of the benefits of a private foundation without the administrative responsibilities and upfront costs. The tax advantages are realized today as it provides an immediate tax receipt for your donation and avoids taxes on capital gains on gifts of growing stock and securities.
This program also takes advantage of long-term growth and gives your donations a chance to grow, which in turn means your favorite charities get more over time. It has flexibility by supporting the charities you want, when you want, and lets you decide which charities will benefit from your gift. The program also allows you to use a variety of different assets, stocks, bonds, mutual funds, cash, to support your charitable giving. Anonymity, if that is your wish, is also built in, as it allows you to give anonymously or to be acknowledged in the name of the giving fund, for example, the Roger Brink Charitable Fund. And finally, it establishes a charitable legacy that can involve your family in your philanthropic decision-making both now and in the future. This allows your successors to carry on your charitable giving goals.
You might be thinking that having your own private foundation is for gazillionaires and not for me. But through this program, you can create a giving legacy for as little as $25,000. You can decide on what asset you have that you would like to use, be it cash, stock, bonds, mutual funds, or life insurance. Give your account the appropriate name you wish the legacy to reflect, for example, the Brink Family Foundation, and you will then work with us to determine which Investors Group fund to invest it into. Every year, the Strategic Charitable Giving Foundation will contact you with the amount that your money has grown and which registered charity you would like to give it to. You can then choose who you'd like to be your successors to ensure your philanthropy continues on beyond your lifetime.
Yes, it is a smarter way to give, and to quote Winston Churchill, "We make a living by what we get, and we make a life by what we give." Wise words from a very wise man who I'm sure is still providing registered charities with the means to continue their great works. So, if you feel you would like to start your legacy, please contact Ella or I to create a tailored fit legacy solution for you.
Okay, now I'd like to give you your action items for today. Create a list of your assets, much like the diagram we showed you earlier. Write down what the asset is, how much you paid for it, or how much you have contributed, and what the fair market value is today. This exercise will give you a one-page look at what your assets are and some insight on how they would be treated if you were to meet your maker today. Compare this list and see if there are similarities between our case study, Roger's, asset list, and yours.
The second action item is spend some time thinking about what registered charity organizations you care about the most and write them down. Your choices can be as simple as the SPCA or the Cancer Society, or as localized as the theater company whose shows you enjoy very much. The only criterion is it must be a registered charity. You can search or review the list at the Canada Revenue Agency website, and the link is on your screen right now. The other option is to Google CRA registered charities and follow the links.
So that's about all the time we have for today. Please join us for next week for our next exciting episode, where your two financial gurus will show you another smart way to ensure your hard-earned money gives you all the choices you want in life. But in the meantime, we would like to hear from you. So please send us your feedback, questions, comments to our Facebook page, which is Dollars with Sense. You can email us at twofinancialgurus@gmail.com and call us at 778-879-0820. We're always happy to receive any questions and comments from you, our listeners. Don't forget, this is our 23rd episode, so there's another 22 20-minute sessions where you can find valuable information on all topics around expert advice on growing and protecting your wealth.
That's right. All of our sessions are now also available on our new YouTube channel. You can go to YouTube and input our names, Ella and Terence, and you will find the Financial Gurus channel, where all of our episodes are available for you at your convenience. As your gurus, we want to remind you that knowledge is really only useful if you take action with it. That is why each and every one of these episodes have an action item that you can do to make your financial future more secure and less of a worry. Thanks again to everyone for their effort in putting this information out to you. Have a great week, everybody, and may your dollars and cents be with you.